Hi, this is Brian Vendig, President and Chief Investment Officer here at MJP Wealth Advisors. Wanted to take this opportunity to check in with all of you and provide an interim market update. We've seen a lot of turbulence and volatility in the financial markets over the past month or so. It's actually been quite a chaotic time since Liberation Day. We've seen the markets have a correction, which was the fifth fastest on record. Volatility levels and uncertainty that actually eclipsed what we experienced back in the pandemic of March of 2020. And I know from speaking with all of you and listening to your concerns, they caused a lot of anxiety over the last month or so. Fortunately, with tariffs on pause, we saw that markets recovered and actually got back to levels where we were before April 2nd or Liberation Day. So now the question begs, well, what lies ahead? Well, I think we have a couple good news items just to keep in mind. Number one, we pretty much completed earnings season with profit numbers coming in well above analyst estimates, and outlooks for profit growth continues on for the balance of the year, even with the concerns of tariffs and higher levels of prices for consumers over the months ahead. The S&P 500 companies are expecting earnings to grow about 6% both in quarter two and quarter three, and a 9% growth in profits in quarter four. At the same point in time, we've seen some recent economic data that still shows that consumer is spending, the labor market is stable, and the economy continues to chug along. Now, I'm not saying there isn't pockets of concern, but in total, it seems like we are going into this next period of uncertainty around trade negotiations and how much tariffs flow through the economy and impact price for consumers with a good foundation. So with that being said, the way we're thinking about things right now is that the uncertainty levels have definitely come down from those historic points earlier in April, but we're definitely not out of the woods yet. We're still maintaining a defensive posture with the portfolios, but we did add back equities as we previously communicated when we started to hear progress on trade. And this was something that we decided to do right when the administration first announced the first 90-day pause. As a consequence, that pause expires July 8th. And between now and July 8th, for all countries ex-China, we are expecting more trade deals to be announced. And I think as that information presents itself, it's going to calm markets and investors' nerves as we move through what's going to happen with trade policy and prices on consumers for the balance of the year. Now, I think on that point, you should expect that over the course of this administration, we're going to still see 10% tariffs on imported goods, which will cause prices to go up on the consumer. However, keep in mind that the highest income earners, the upper 10% of people in the income brackets in the United States, are the ones that contribute to around 50% of total spending in the United States. So as long as we still see somewhat stability in the labor markets, if people in America have jobs, they have confidence, and they spend. And I think that is still in the cards for the U.S. economy. So it is a jump ball. I still think there's a 50-50 probability of a recession over the next 12 months, which is really determined based on the progress of these trade deals. But if more and more of these trade deals come to be over the next couple of months, which we believe, and also a longer term framework that comes to be over the balance of the summer for China, then I think the U.S. economy can divert those concerns around a recession and still have positive economic growth in 25. Now, of course, if things go contrary to this view in the short term, then we'll get more defensive with the portfolio. But one thing that we have done over the last couple of weeks to be more defensive is we continue to reduce duration of bonds in your portfolio, and we actually lowered our allocation to U.S. Treasuries and decided to actually go very short term on the 1 to 3 month Treasury bill side, just to have a place to collect a positive yield for your strategy, but lower volatility as it relates to interest rates. Because we think over the next couple of months, interest rates have a propensity to potentially go up as we see maybe prices increase on the consumer. But because the consumer is sensitive to price, and because we do think that there's some damage has been done to the economy because of lower sentiment because of the impact of tariffs, that consumer demand over the course of the year could slow, the economy could slow, but that should bring down inflation as well as bring down these interest rates. And then we think later on in the year, the Fed will probably cut rates one or two times, which will be supportive for the economy and also supportive for the consumer. So in summary, if we get progress on trade, we continue to see earnings growth from publicly traded companies, and we'll hear again from them in July. We're going to keep a watchful eye on the balance between growth stocks versus tech stocks. We're going to keep those things in balance, and we're going to watch the duration of bonds as we kind of move through the next couple of months. But when you put that all together, that still sounds like a glass is half full scenario for investors. And look, I still think there's going to be a lot of volatility. We've seen a dramatic rebound in the markets, which means that probably at some point over May into June, there might be some consolidation in the market, a traditional pullback. But I think once we get into the July earnings season, assuming some of the economic data continues to come in a consistent pattern, and as I mentioned, we get these updates on trade, the second half of the year could shape up to be a better first half. So we'll see how things go over the next couple of months. We'll keep you informed with our ongoing communications over email. Please follow us or check us out on social media if you do that on LinkedIn or YouTube or on Facebook Meta. That's a great way to get some additional updates from us. And we'll do our best to keep you informed. But right now, we're keeping a watchful eye on risk, keeping a watchful eye on our portfolio allocations, and doing our best to help you during these uncertain times. So I hope you all have a great balance of the spring and into summer. Enjoy time with your families and friends, and we'll keep you posted as we get further updates. So thanks so much for your time, and look forward to speaking with you soon.